What's up, everybody? This is Heresy Financial, and today the Federal Reserve just cut interest rates again by another 0.25%. We're going to dive into what that means and what we should expect going forward. Let's dive in. All right, so there are a couple takeaways to the Federal Reserve cutting interest rates again here, third time this year by another 0.25%. Before we dive in though, if you are new to the channel and you like the content that you listen to on this episode today, please hit the like button and the subscribe button. Help a small channel out and share it with somebody else who you think will also enjoy it. On this channel, we look at anything happening in the financial atmosphere, whether it's news, something from the Federal Reserve, something happening in the markets. We dive into what's really happening behind the scenes and how it affects you. While the Federal Reserve was having their press release today during the Q&A session after the statement, I was watching it live and tweeting about it during the announcement. So if you're not already following me on Twitter, that's a good place to receive live updates about anything happening in the market. But let's dive into what they said and what we should expect going forward. The first thing that I noticed was that they were really trying hard to not give any indication of what they were going to do going forward. Now, most people and most analysts and the market expected this cut, and so everybody was really interested in what they were going to say in the statement and the question and answer session after the statement was given to determine what we can expect going forward, because like I said, it was largely expected that this rate cut would happen. And if you're not aware, the Federal Reserve employs dozens of people and their only job is to write these speeches and to prepare answers for questions during these statements and press releases. And they literally agonize over every single word and phrase because they know that the markets will move and that investors and big money makes decisions based off of the words that the Federal Reserve says. And so because they know this and they craft their words carefully, it turns into a self-fulfilling prophecy where you actually do have to pay attention to what their words are to try to read in between the lines to see what they are thinking. Because God forbid the Federal Reserve just be honest and tell people what's actually going on. Let's turn it into a game. So Jerome Powell in the question and answer session flip-flopped a lot today. He said that the economy looked really strong and he cited a bunch of numbers, but he also said that there were big risks that they were paying attention to. If you could summarize his statement and his answers today, it would look like we're going to keep interest rates the same as long as nothing in the economy changes. And if something in our economic outlook changes, then we'll respond accordingly. Now, something to note is that the Federal Reserve never cuts interest rates or intervenes in markets unless they are responding to something that looks negative. And so with all of the talk that he gave about things looking strong, we know that by their actions, lowering rates, there is a high level of concern within the Federal Reserve on what is coming around the corner. And one of these areas that really stood out was the recent repo market interventions, which are continuing, and they will probably continue in perpetuity for a very long time. What was interesting was that he refuted the original explanation as to what caused the spikes as being a liquidity shortage. He said that most banks actually had largely adequate reserves beyond what they felt comfortable with. And he said it's a really good question to ask why they were not lending even when rates spiked up, which would have been an opportunity to make great money on those cash loans. And so he said it's really important to understand why they were not loaning their overnight cash when this opportunity presented itself, when there was abundant liquidity to be loaned out. And it is a great question, but it was really funny because he offered no answer. Now, the clear answer and the obvious answer would be that the collateral being offered in the repurchase market is not creditworthy. Because in the repo market, if I loan you cash, you have to give me collateral, and then when you pay back that loan, I'll give you your collateral back. And so the most likely answer is that there's a large amount of collateral or assets that the financial services industry has right now that are not creditworthy. And so even though I have an abundance of cash, I'm not going to loan it to you because I don't want your collateral. Well, the Federal Reserve doesn't care about the creditworthiness of the collateral, and so they'll print money and offer it at the extremely low rates in order to prevent rates from spiking. Now, the other thing that's really interesting is their comments on inflation. Now, if you listen to the actual statement and answers, the words symmetric inflation came up over and over and over again. Now, it used to be that 2% was the max, it was the cap on inflation. And back in 2002, when the Federal Reserve started talking about deflation as the deflationary boogeyman and saying that it was this scary thing that they had to avoid, manufacturing that fear out of thin air, because deflation is not actually something to be scared of, they set 2% as the cap on inflation. And they said, we have a mandate by Congress to achieve price stability. But in order to make sure we don't accidentally have deflation, we're going to go a little bit above zero and we're going to have a cap at 2%. Well, over the next couple of years, slowly that turned into a target of 2% instead of a cap of 2%. And now it's a symmetric 2%. Now, symmetric just means that if last year we had less than 2%, we need to make up for it this year. And so he readily admitted that we have over 2% inflation right now. It's just not over 2% symmetrically, meaning that we're still trying to make up for the lack of inflation that we've had in the past. Now, if you've been around this channel at all, you know that the CPI is an extremely poor indicator of inflation, and they changed the way that CPI is measured in the 1980s. And when they changed the way that CPI was measured, all of a sudden inflation magically was fixed. And so when you look at private statistics on inflation, especially by city, it looks like the average inflation over the last 5 years has been somewhere around 10%, not under 2% like they're talking about. And it's because they exclude certain things that actually have been increasing in cost that affects the everyday lives of everyday citizens, like healthcare costs and food and energy and tuition that most Americans have to pay for that have been exploding in prices, but the way that they measure it is to exclude those things and then measure the other things they are including in a different way to make it look like inflation is not really happening. And the reason they need to do this is because they need interest rates to be low to continue this facade of a good economy. They need the government to continue to be able to borrow, and they need corporations to not have to go under or not have to pay back all that debt with pain and savings. And so they need interest rates to be low to continue this easiness of rolling over debt. If everybody knew that inflation was really actually high, well, they would demand through the market a higher rate of interest because right now, interest rates nominally are a little under 2%, but in reality, they're less than 0%. Because if inflation is, let's say, 2%, but interest rates are also 2%, well, that means that your real interest rate is zero because inflation and interest rates offset each other. What that looks like in practice is that if you have $10,000 of money in your bank account this year and inflation is 2%, well, that means next year the purchasing power of that $10,000 will only be $9,800. So it doesn't matter if you get a 2% interest rate on your savings account because then you're just breaking even. And so if you know inflation is high, eroding the purchasing power of your dollar, you're going to demand a higher interest rate on that cash. The Federal Reserve can't let interest rates spike. They can't let the market force interest rates up. So they have to make the market think that inflation is low. Now, going forward, what will likely happen is an escalation in trade tensions. This happened a couple of months ago when the Fed said we're not going to lower rates again unless global trade tensions and global tensions escalate. Very quickly after that, Trump decided he was going to intentionally escalate the trade war. And so we'll likely see something like this happen again that will give the Fed reason to say, hey, now we do need to lower rates again. On a side note, I know that I talk about inflation a lot, and that's because it's probably the number one most important thing to understand if you want to make good investing decisions. Because if you understand what inflation really is and how it really impacts people, you're going to realize that you should not be investing in things that are negatively impacted by inflation, and you're going to look for inflation protected or hedges against inflation in your investments. Now, stocks are something that are usually benefited by inflation, but things like CDs or bank accounts or savings accounts or bonds or fixed income or annuities, Social Security, anything that's a fixed income sort of investment are things that are massively hurt by inflation. So it looks like we're going to get a lot more inflation, especially because the Federal Reserve is still not being honest about how much there really is. And they are monetizing more and more of the US government's debt. So we're likely to see that tick up even higher here in the future. Now, I know I mentioned this on another video. I do have my options course out now. So if you'd like to learn how to use options to protect yourself in the stock market, or to use it to speculate or to produce income on an account, you can use options for all of that. It's an options course for people who have no experience with options. And so you can check that out. I'll link it in the description below. If you enjoyed the content, thank you so much for watching. Please like, subscribe, and pass it on to somebody that you think will enjoy it as well. Thank you for watching. You have a great day.